So let's talk a little bit more about some U.S. growth stuff, right? In terms of the U.S. economy, there's a few things that we see. This year we see growth around 1.5%, a little below the IMF numbers. Next year we see it a bit weaker, a little below 1%. But for 2018, we see it closer to 3%. Now you might ask me, why do I see slower growth next year? And what you might have seen is a number of financial markets, especially since the election, have been doing some crazy things, right? You've seen the stock markets at record highs. You've seen the dollar at the strongest level in 13 years. You've also seen yields at the back end of the yield curve go up, right? So what this tells us is that maybe we're going to get more growth, right? And I'll talk about election implications in a minute. But what we're probably going to get most certainly is more inflation. And so you're seeing a rotation of investments out of bonds into other stuff, whether that's equities or commodities or going anywhere else, because there's a risk of inflation. I'll talk about why in a minute, but really if we expect, and I'll show you the data, our corporate clients expect from a Trump administration corporate tax cuts, personal tax cuts, deficit spending, and a reduction in regulations. In other words, they're expecting in a Trump administration to see tax cuts like a Republican and deficit spending like a Democrat. Really good for short-term growth. More challenges for long-term debt stuff, but that's already a massive problem that I probably won't talk about today. But what there also is then is a risk of inflation. And then the Fed has to fight essentially against stimulative fiscal policies. So we do see increases in the Fed funds rate, and we also see rises in inflation. Now, there's a couple things I want to talk about the current state of the economy that also make me a bit nervous, right? So it's not just these expectations. And by the way, one of the reasons we see a slower growth rate for next year is because even if there are all these goodies, right? Personal tax cuts, corporate tax cuts, and additional deficit spending, it's going to take 6 to 9 months from now for that money to show up. In the meantime, interest rates at the back end of the yield curve go up. The Fed raises rates to fight inflation at the front end. And although companies want to make investments, they probably trust but verify. And by the way, investment hasn't been great. This is a chart of investment from GDP, and less important to see the numbers, but there are some red boxes on the right that I'll talk about in a second. There are 4 things that go into GDP: consumption, investment, net exports, and government spending. And let's take government spending off the table for a second. Net exports, those haven't been great. There actually was 3 consecutive quarters of contractions in exports, what we saw in Q3 and Q4 of last year and Q1 of this year. And if we look at investment, consumption's been good, and that's what's been fueling growth. But investment's a bit of a problem, right? If you don't plant seeds, trees don't grow. And for the last 4 quarters, fixed investment has been in recession. In 3 of the last 4 quarters, we've seen contractions in overall domestic investment. Now, what's the difference? Domestic investment, all of it, includes fixed investment for non-residential, in other words, corporate equipment and investments, intellectual property, structures, in other words, buildings, as well as residential buildings, right? So new homes are in this mix. The most recent GDP report showed the last 2 quarters, there's actually been a recession in home sales, right? That's the red box at the bottom. In terms of equipment, the next red box up, we've had 4 consecutive quarters of a recession in equipment purchases and investment. If we look at fixed investment overall, that means for the last 4 quarters, for a full year, we've had a recession in investment excluding inventories. And it's only because there was a rise in inventory in Q4 that you've seen that was positive. So this isn't great. You're in an investment environment where you have had and are in some respects, a recession of investment. That's bad, right? It's one of the 4 big components of GDP. You're getting consumption, but if you have a recession in investment, that's a problem. And the question is, even if people feel more optimistic, even if in corporations they expect these tax cuts, coming out of a recession in investment, are they going to make those big expenditures, or they want to see tax cuts and spending happen first? My expectation is they want to see the proof is in the pudding before they pull the trigger on spending more money, especially if the Fed's raising rates, increasing the cost of capital in the short term, and you're seeing treasury rates and long rates go up at the back end.